September 1929. A man walks into a bank in Manhattan. He liquidates everything. Stocks worth millions, bonds, real estate trusts, everything converted to cash in 3 days. The banker asks why. "Just a feeling," he says. 8 weeks later, Black Tuesday. The Dow loses 12% in 6 hours. Men jump from office buildings. Fortunes built over generations vanish before lunch. That man? Joseph P. Kennedy. He's already buying back in at 30 cents on the dollar. Summer 2008. Lehman Brothers is still rated A+ by every major agency. The public thinks it's one of the safest banks in America. But inside the executive suites, something different is happening. Millions of shares, sold quietly, transferred to shell accounts, liquidated through private brokers. Not because of anything the public knows, because of what they know the public will learn in exactly 2 weeks. September 15th. Lehman collapses. $600 billion evaporates. The global financial system nearly follows. Those executives, they walk away with hundreds of millions intact. Right now, October 2025, Bill Gates owns more American farmland than anyone who isn't a government. Ray Dalio's fund holds billions in physical gold. China's central bank bought gold for 11 straight months, not because CNBC told them to, more likely because they can see signals you can't. Every collapse has 2 groups of people, those who saw it coming and those who paid for not seeing. The difference between them isn't intelligence, it's access. And access has a price you're not invited to pay. If you've ever felt like the game is played on a level you can't see, you're right. Drop a comment, because you're not paranoid. You're just not in the room. Rome, 380 AD. The city still feels eternal. The Forum bustles with merchants from 3 continents. The aqueducts flow with engineering that won't be matched for 1,000 years. Citizens believe in Rome the way people believe in gravity. But something is happening that the mob can't see. Evidence suggests that families like the Anisi and the Simaki, the old patrician bloodlines, the senatorial elite, are quietly moving east. Estates near Rome sold to provincial governors at steep discounts. Gold reserves transferred through merchant networks. Relatives relocated to Constantinople under diplomatic pretense. No announcements, no speeches about decline, just silent, methodical repositioning. By 390 AD, many of Rome's wealthiest families have done the same. Not because they're cowards, because they can read ledgers the masses never see. The Visigoths haven't invaded yet. The city hasn't fallen. But the treasury reports tell a story the street corners don't. Revenues collapsing, legions unpaid, borders hemorrhaging. Diocletian's reforms decades earlier had created legal protections that made it easier for elites to transfer assets east, while the Roman poor remained bound to their land by law. By 410 AD, when Alaric's Visigoths finally sack Rome, the wealthiest families have been gone for 20 years. The city burns, the people starve. The senators? They're in Constantinople, discussing philosophy over wine imported from estates they still own in Gaul. They didn't have crystal balls. They had accountants, and access to the imperial treasury reports before they became public knowledge. When you can read the empire's books before the empire announces them, you don't need prophecy. You just need to leave before the exits get crowded. Back to 1929. Let's talk about the 8 weeks nobody discusses. September through October, the weeks that separated the insiders from everyone else. Joseph P. Kennedy exits his entire stock portfolio by mid-September. Complete liquidation, 0 market exposure. Bernard Baruch, financier, advisor to presidents, begins shorting the market heavily in late September. Jesse Livermore, the most famous trader of the era, takes massive short positions starting October 1st. None of them are psychic. They're reading signals the newspapers won't print for weeks. Unusual selling volumes, whispers in private clubs, margin calls that haven't hit the financial pages yet. The National City Bank pushes $650 million in stock sales throughout October, desperate to offload before something breaks. But the public? They're still buying on margin, still believing headlines that promise temporary correction and healthy consolidation. October 29th. Black Tuesday. $14 billion evaporates that day alone, equivalent to over $200 billion in today's dollars. By November, Kennedy, Baruch, and Livermore have collectively made tens of millions in profits while the nation bleeds. Congress investigates eventually. They ban short selling for 2 whole days in 1931, after the money is made. But here's the part history textbooks skip. Kennedy didn't just survive the crash, he bought back in at the bottom. Real estate, blue-chip stocks, distressed businesses. By 1935, he's one of the wealthiest men in America. His fortune, built entirely on knowing when to exit and when to return, will eventually put his son in the White House. The pattern is elegant in its simplicity. Access to information isn't just power, it's a time machine. While the public reacts to news, the wealthy react to conditions. By the time you read about a crisis in the paper, they've already repositioned for the recovery. Not because they're smarter, because they're earlier. If this is making you rethink who gets to know what and when, hit that like button. The game isn't rigged, it's just played on a field you can't see from your seat. 2s and 6. Washington, D.C., members of Congress sit in a closed-door briefing about subprime mortgage exposure in the banking system. The public presentation, the one released to newspapers, says everything is contained. Manageable risk. Strong fundamentals. The private briefing for the House Financial Services Committee tells a different story. As one example from later reports, a congressman sells $250,000 in bank stocks within days. Not illegal, not even unusual, just profitable. New York, 2007, Lehman Brothers headquarters. The CFO reviews internal documents showing $60 billion in toxic mortgage-backed securities on the books. 2 weeks later, the public earnings report declares strong quarterly performance and a solid balance sheet. Senior executives begin quietly selling their personal holdings. Not all at once, that would trigger regulatory scrutiny, but steadily, month after month. Richard Fuld, the CEO, will later testify to Congress that he believed Lehman was sound until the very end. But investigations reveal that between 2000 and 2008, top executives cashed out over $1 billion in bonuses and stock, long before the public understood the depth of the problem. Summer 2008, Goldman Sachs. Board member Rajat Gupta receives a confidential call about upcoming quarterly losses. He makes another call to hedge fund manager Raj Rajaratnam. Rajaratnam immediately shorts Goldman stock. 2 weeks later, when the losses go public, he profits $17 million. Gupta was later convicted in 2012. Details differ by case, but the pattern stands. Private information precedes public pain. The Financial Crisis Inquiry Commission's 2011 report documents dozens of similar cases. Different names, same mechanism. September 15, 2008. Lehman Brothers collapses. The global financial system teeters. Governments scramble. The public panics. The insiders, already hedged, already liquid, already positioned for the recovery that will make them wealthier than before. This isn't conspiracy, it's latency. The time gap between when something is known privately and when it becomes public knowledge. And in that gap, measured in weeks, sometimes just days, entire fortunes shift direction. The system doesn't reward prescience, it rewards proximity. October 2025. Let's examine what the wealthy are actually doing right now, not what they're saying on CNBC, what their filings show. Bill Gates, 270,000 acres of American farmland, $813 million invested since 2013. Most recent disclosed purchase, $113 million in Nebraska, 2017-2023. Not for farming, for portfolio resilience. Hard assets that don't fluctuate with currency markets. Ray Dalio's Bridgewater. Shifted fund positions toward 1.5% gold in recent years. That's billions in physical gold. Not gold stocks, not ETFs. Physical bars and vaults across Switzerland and Singapore. Elon Musk disclosed Texas ranch compound purchase in 2024. Over $35 million. Substantial acreage. Family insulation. The Rockefeller Foundation, $500 million allocated to sustainable agriculture via their Zero Gap Fund by mid-2025. China's central bank, 298 tons of gold by Q2 2025. 11 consecutive months of purchases, approximately $283 billion in reserves, not for yield, for de-dollarization, for structural insulation from Western financial systems. And the family offices you never hear about, the private wealth managers, the sovereign funds, they're executing similar strategies. Farmland, vaulted gold, digital custody solutions, real estate in jurisdictions with stable property rights. Not panic, portfolio resilience. Meanwhile, IMF projections show U.S. debt rising from 122% of GDP in 2024 to an estimated 143% by 2030, though projection ranges vary by methodology. Interest payments, $1.2 trillion annually in 2025. Inflation risks, tilted to the upside. The public reads those numbers and thinks, someday. The wealthy read them and adjust positions today. Because they understand something most people don't. By the time a crisis becomes consensus, the safe harbors are already expensive. By the time cable news covers the collapse, optimal exit prices are history. The time to reposition isn't when everyone agrees there's a problem. It's when the data suggests there might be one, and the wealthy access that data before it becomes consensus, not through conspiracy, through advisory networks, private briefings, research services that cost 6 figures annually. The average investor learns about economic shifts from financial news. The wealthy learn from the analysts who will eventually brief the news anchors. March 2023. Silicon Valley Bank collapses. Over $3 billion flows to stablecoins and Bitcoin within 48 hours. Who moved first? Crypto-native founders, portfolio managers in private networks, people with direct banking relationships. Who moved last? Depositors who read about it at breakfast. Bitcoin, $111,000 in October 2025. 40 million US users. India leads global adoption metrics. But examine the on-chain accumulation data. The largest position builds happened in 2023 and early 2024, before mainstream awareness. The pattern never changes, only the asset classes. Rome's senatorial families moved to Constantinople. Kennedy moved to cash. 2008 executives moved to government bonds. 2025's wealthy are moving to land, gold, and decentralized custody, not because they predict the future with certainty, because they can afford to be early. And when you're insulated from immediate consequences, you can act on probabilities instead of waiting for proof. Subscribe to Wealth Wars. We track what the wealthy disclose, not what they promise. Because by the time they're discussing it on panels, they've already executed the trades. The Roman senator who watched peers relocate before the sack. The banker who exited before Black Tuesday. The executive who liquidated before Lehman's collapse. They all made the same bet. That proximity beats analysis. That being in the room where decisions are made is worth more than being brilliant in a room where decisions are merely reported. The pattern was never about money. It was about timing. The wealthy don't generate returns in chaos. They generate distance from it. They don't predict collapse. They insulate portfolios from it. Then they re-enter when everyone else is capitulating. This isn't about conspiracy. It's about latency. The time between when information exists privately and when it becomes public knowledge. And in that gap, measured in weeks, sometimes mere days, entire fortunes change trajectory. History never warns the masses first. It whispers to those with access. And by the time the echo reaches you, optimal positioning is already past tense. The question isn't whether you can see what they see. The question is whether you'll act before it becomes obvious to everyone. Because once it's obvious, it's expensive. If this video revealed a pattern you can't unsee, share it. The information gap isn't narrowing, it's accelerating. Subscribe to Wealth Wars. We decode disclosed moves before they become headlines. The next repositioning is already underway. Will you recognize it before it's consensus? They didn't predict the fall. They prepared for it.